Welcome to the Multifamily Investor Nation Show. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm so excited that you guys have joined me today. Today, we have a very special guest, Gino Barbaro. Gino, welcome back to the show.
Second time on Whitney. How you doing? I'm doing
I am
great.
too. Well, the past 12 to 24 months has been a really difficult time for people to close apartment deals. But I think it's important to show listeners that it can be done. So I'm excited to talk to you today about Tillery Apartments, 105 units in Knoxville, Tennessee. But before we dive in, for those listeners who didn't hear your last episode, tell us a little bit about yourself and your background and how you got into the multifamily space and where you're at today.
I was a restaurant owner, got out of college and the family owned a restaurant and I loved it. I loved working with my dad and it was just great. It was just a great family experience for me for years. And in 2007, unfortunately, he passed away. So imagine a little 7-year-old boy going to work with his dad. And when he's 37, his dad passes away. And for me, I don't know if I loved the restaurant or I loved working with my dad. And that's when I had to really start revisiting things and saying, ah, is it his dream or is it my dream? And I really think it was more of his dream than mine. And I just started falling in love with real estate. I read the book by T. Harv Eker, Secrets of the Millionaire Mind. Everything started to change. I started taking responsibility, started really working on personal development. I met my business partner, Jake. He was a pharmaceutical rep at the restaurant. He was taking out, food orders to doctors' offices and selling vaccines and selling, pharmaceuticals. In 2011, he moved to Knoxville, Tennessee by the I guess of grace of God. We just stumbled upon an amazing market we didn't know. When he moved down there, we started looking at deals. And in 2013, after 18 months, we bought our first deal. Then we bought our second deal, bought our third deal. And I think we were off to the races. And I think it's beginner's luck, but it's not beginner's luck because I had made so many mistakes before I met Jake and I had so many learning lessons and we created this framework, buy right, manage right, finance right. I didn't have the map or the process before I met Jake. I kept making the same mistakes. And I have to say, Jake's been very lucky to have met me because I've taught him everything and I've actually helped him from not making my mistakes. But it's a great partnership because I really would not be here without him because he's been an amazing partner. He is the kind of partner you want to have on your side. He works hard. He's got a growth mindset. He's just a really ethical person. He's always thinking about the long term and he's always trying to get better. So there's no better qualities for me. And, I'm just really lucky to be here today.
Awesome. Well, thank you so much for sharing, Gino. And guys, if you haven't read the book already, Wheelbarrow Profits tells a lot of both of their stories in there. And that is one of the first books that I read whenever I started getting into multifamily purchasing as well as investing. So you guys check that out. Um,
Mhm.
well, Gino, let's talk about Tillery Apartments, 105 units in Nashville, Tennessee. When did you close on this property and what was the purchase price?
When we closed on it, it was last year. But if we go back to our previous podcast that we did together, we had talked about Random Forest. We closed that in March. And we are like, wow, we finally got 128 units. We've done a deal like the year before in 2020, 2022 was slow. We only did about 80 units. In 2023, we opened with a bang and we're like, okay, we've got teams going on. We've got a CapEx team there. And then all of a sudden this opportunity, Tillery comes along and it's like, we do both. And we're like, we're going to figure it out. And we're vertically integrated. So we have property management in house. We have the CapEx team in house. We took on a big asset. So in July of 2023, we decided to buy the deal. It's 105 units, $10.5 million purchase price. There's so many things we liked about it. And as an investor, whether you're a passive investor or an active investor, we have what we call the buy box, your buy right criteria in the buy right. And this baby checked off a lot on our buy box, 100 units plus, 80s vintage. So it was newer, nice unit mix, townhomes, 2 beds, 3 beds, nice size units, nice amenities on it. It had a nice clubhouse, great pool. It just looked nice. It was a nice community. Now, the downfall or the downside was it just needed a little bit of love. As you get older, you need to take care of yourself. And if you don't take care of yourself and you let yourself go, well, you have Tillery. I mean, the trees were just coming and encroaching on the property. The driveways were a little bit rough, right? The pool, it was closed. How can you have a pool closed 105 units? It had chain link fence around it. We have this pickleball slash tennis ball court that we want to turn into possibly a pickleball or even a dog park, chain link fence. It just needed a little bit of love. It was tired. And when we saw it, the buy box. We love the median income as well. Once again, the vintage was great. The unit mix was great. We had washer dryer hookups in the apartments. That was great. And obviously, what we're all looking for in multifamily investing as a value add investor, the marketers, the brokers would say material value add. Rents were at $700. I mean, they should be $1,300 in that market. So the owner just kept rent suppressed because he didn't want to do any of the work. And we saw that there was a ton of value add potential on there. Now, getting into it, it's difficult to raise rents from day one because you've got leases and all, but that's where the value add is. And for us, it was one of those properties that we learned a lot. It was a really big learning lesson. But when you see a deal like that, and for anybody listening, really create your buy right criteria. So when you see a deal, you don't even have to really underwrite the deal. You already know it works. Then you do your deep underwriting and say, hey, where should the price be? What type of debt should you have? But we saw when this deal came across our desk, we're like, winner, winner, chicken dinner.
I love that. I love that. So, when did you find this? So you closed on that previous deal in March. Was that already on the table for you? Like, did a broker bring it to you? Were you competing with
Great
others?
question. This is why you guys have an amazing brand. And I like to think of Jake and Gino as having some type of presence in the multifamily space. And for those of you out there wanting to syndicate, wanting to raise capital, you need to get out there. Don't be afraid. It doesn't matter how you look. You're never going to look as great as you look. You're never going to sound as great as you look. You're going to make mistakes on camera. That's okay. This deal was actually brought to us by a Jake and Gino student. He was wholesaling it to us. So if I had never created the brand, I never would have had this opportunity. And it's interesting because the third deal we closed at the end of 2023 was brought to us from a broker who loved Jake and Gino and wanted to do a deal with us. So for those of you out there saying, really brand is not that important to me going forward, it's one of those things that can really separate you from others in the crowd. And you don't have to start out with everything figured out. Start writing articles. Start going on LinkedIn, connecting with people. Start doing property tours. Start videoing yourself. It's going to feel awkward if you've never done it before. Trust me, it's not fun. But if you can think in the back of your mind, this is long term, one video a week, two videos a week, just start getting out there. Start talking to investors. Start creating content from investors who you're speaking to. What are their pain points? Start speaking to that person, to that pain point, and to how you're going to be able to solve their problem. And I promise, if you work on your brand over the long term, it will come back to you tenfold. Because when a deal comes out there, brokers are going to look for who's going to be able to execute, who has the bandwidth to do this, or who is the person in the multifamily space that will be able to close this deal. Because that's what brokers want. They want certainty of close. They want an easy transaction. Their job is hard enough to deal with the seller who's nuts, your price is crazy, and to deal with a buyer who doesn't want to pay anything. So that's a tough enough job. So let them find you through social media, through anything, and let them know that you're there to close.
I love that. And those guys, if you did not catch everything, make sure to rewind the past like 2 or 3 minutes because that is amazing advice. You can't just like throw up a website and expect that deals are going to land in your lap. You actually have to do the work. And social media, YouTube, there's millions of people on YouTube. Like you gotta just put yourself out there, and it doesn't have to be beautiful. For me, I will speak on my personal journey really fast.
Yes.
I'm a recovering perfectionist, and it took me 40 plus years to figure out how to do this.
Yes.
I
Yes.
dated myself. There you go. Anyways, but I want to get back to the deal. Okay, so your student is wholesaling this to you. How did you guys nail down the offer on the property? Like, how did you guys hammer out this contract? What was in the contract?
Great question. But before we move to that, I just want to really address what you just said. If you're afraid and you're a recovering perfectionist, go out and find a partner up, because you will do more not to let your partner down than you will to you'll let yourself down every day of the week. But I know that every day I'm showing up and doing my job because I know Jake's relying on me. And I think subconsciously he's doing the same thing. And I'm doing this for my family as well. I consider them my partner. I consider them my why. So if you have the weakness or you're not holding yourself accountable, find somebody to hold yourself accountable. Now, to the deal specifically, this wholesaler made a significant amount of money flipping it to us. And we figured, hey, rents are around 750, 800, 700. We can't pay more than 100,000 a unit for this property. That's where we landed on it. He made a ton of money flipping this deal. Unfortunately, I mean, not for my sake, but for his sake, understanding the power of deferring that transaction into really working that property and delaying the gratification and thinking about the equity on the back end is what really truly makes you rich in this business. But sometimes, hey, that equity, that transaction, you can't let it go. They probably made a couple of $1 million on that flip, but it was stress, it was heartache. And I think he actually ended up closing on the deal and then same day closed to us. So everything had to work in perfect. All of our debt had to be lined up. Yeah, you eyeballs exactly. It was stressful. I remember being online at the airport, getting onto a plane. It was a Friday afternoon, and Jake is like, "I think we got this thing," and it was just communications back and forth, and him having the confidence that when he bought it, he had debt lined up. He had short-term transactional debt. We were going to close on the next. Because if we left him hanging, I mean, it would be a nightmare for him. So having all of that worked out, but that's the value, Ed. We were the ones who were able to close for him. He sought us out because he knew that we could close on this deal.
Awesome. Okay. So, how was this contract structured? And I want to make sure that you're comfortable sharing the details with us because we haven't covered a transaction like this before, a wholesale kind of flip. And so, can you like walk us into greater detail,
Sure. I'm
like the
going to try to remember
timeline
this.
and how the
Yeah.
due diligence worked out and how, was the earnest money down? Can
Yes.
you help listeners understand?
Yeah, it's basically like a wholesale transaction for residential, but on this one he had to close, so he had to get short-term financing, take it in his name, and same day from there we had to end up closing. So we bought it ourselves. We didn't syndicate this deal. It was me, Jake, and my business partner Mike, and we have what we call the golden golden ticket club. That's something that we have for our employees that they're able to invest with us. And it's great. So we had about 5% of this deal carved out for our employees. So we came up with the rest. So we had earnest money down. It was just a simple kind of transaction. But on his end, and I was always understanding, I didn't really understand why he had to take it in his name instead of just assigning the contract over to us. I can be honest with you, Whitney. I don't understand why that had to occur, but that's the way he structured it. He took title. We had all our stuff lined up. So that's the problem. It has to happen. And if it doesn't happen, I don't know what would happen if it didn't happen. It's one of those things where you need to make sure. And it's the same thing. We had a 30-day due diligence. So we were able to go on the property, tour the property. And it was a little awkward because I think the seller realized, oh, wow, this deal is getting wholesaled. But really the seller shouldn't really matter what happens on the other side. He's getting the price that he asked for. He's getting compensated. The deal's getting closed, but it's a simple transaction as far as just the whole mechanics of walking through 30-day due diligence. Once that's over, our debt has to get lined up. So it was a stressful close just from start to finish. I'm not going to lie to you. It was.
Well, before we get into like the debt and the lending and all that and the added stresses here, like how did due diligence go? Like how did the physical and financial due diligence go down on this
Well,
property?
well, like I said, it was a beautiful property that needed a lot of tender loving care. I mean, I have the what we call a capex tracker. We knew right away we were gonna have to spend a couple $100,000 on the concrete. We're talking about tree removal, a ton of tree removal, a lot of driveway work. That was apparent. But when we went into these units, a lot of them were in better condition than what we thought. Because you're looking from the outside, you're like, huh, this is going to need a lot of work. But going in, these units were sizable, they were nice. He had done more work on the interiors, which didn't make any sense to us as far as the exteriors. I've got some other stuff that I wrote down here. We had gutters, downspouts, we had sidewalks, we had tree trimming, we had shutters, we had landscaping, sign. We had to secure a lot of the fencing around the property. So it was a lot of work on the front end, but it's a lot of the stuff that you can take care of, you can cure. It's stuff that you're looking for that you can add value to the property. And as you're doing it, materially, the residents living there see the value, see the capital that you're putting into the property. So when they do get rent renewals, they understand, hey, I'm not just getting my rent raised because these landlords just want to make money. They're actually investing into this property.
Amazing. Well, so let's talk about the financial due diligence on the property. Like, did everything kind of pan out like you thought it would? Were there any
It
things that
did
you
for
considered
us.
there?
We use a community bank, so we got an 80% loan to cost on this. So for us, loan to cost is awesome because it gives us 5 years. of a runway. 80% of the loan proceeds are baked into the loan itself. And it was through a community bank that we've used for the vast majority of our deals. We've got 2 years of interest only. And it's great because after the 2 years interest only burns off, it'll go to principal and interest. But we're hoping in the next 2, 3 years, rates will come back down. We'll be able to refinance this property. But we were able to pull out $1 million of capital expenditures on this. And I can walk you through real quick of where we are right now. In August of 2023, there's $1 million in CapEx. As of March 2024, there's $400,000 left in CapEx. So I would just venture to say that everyone who's doing a turn or doing a deal, have your CapEx tracker and have a budget every month as far as how many units you're turning, what CapEx projects are going on, and just track it every month. And that has served us really well. It's great between you have your property management team and your maintenance team, and they're coordinating the jobs. They're knowing exactly what's going on, whether they're repairing breezeways, they're doing concrete work, they're working on roofs. You know exactly how much money is going on to each project, and we keep that tracker. And this is a great tracker if you're syndicating deals and you're wanting to convey to your investors, hey, we've done this work this month. We've spent $300,000 in CapEx over the last 3 months. These are the projects that we've done.
So just for clarification point, you're saying the tracker, keep this, tabs up front rather than booking the expenses later.
Yeah, no, we're actually booking them, but what we're doing is we have, like, let's say our CapEx started at $1 million in March, in July, August. How much should we spend? 30,000. Well, we have $970,000 left of CapEx. We had 30,000, and then you're just writing out exactly what you're doing, and it really keeps everybody accountable. And it's something where it seems so simple, but we didn't do that in our previous deals, and it just makes it really clear. And when you have a couple of different projects going on, remember we had the project that we closed in March. Now we've got this one. Well, we've got two big CapEx projects going on at the same time. So we're like, we need to track these things individually.
I am so glad you said that. And I'm going to have my husband listen to this podcast because he gets really uh, frustrated sometimes when we have capital projects going on. I'm like, how much did you spend? Where's the receipt? Like, not only do I need that for bookkeeping purposes,
Yes.
but like I'm constantly like, how much dollar amount do we have left? And he was like, but we're going to spend what we're going to spend. I'm like, no, 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 no.
Oh,
Hold
yeah.
on. So I really love that. All right. So you talked a little bit about securing debt on this property from a community bank. Can you get into like, was it fixed rate debt, floating rate debt? Can you get us into kind of
Yes.
the interest only, prepayment penalties, anything like that?
Fixed rate debt. So community bank, 5 years, fixed for 5 years. That's what we like about it. We could have gone to a non-recourse type of short-term bridge, but we didn't want to do that because 24, 36 months, we don't know. That extra 2 years gives us a huge buffer. And it gives us really, I mean, when I'm thinking about it, two ways you lose money in this business: you either run out of time or you run out of money. Now, speaking specifically to your husband, you're going to spend the money you're going to spend. That's not a good business plan. You don't want to run out of money, because if you run out of money, you're going to get out of, run out of business, right? So for
Well,
us,
you know who manages the money in that on those projects, right?
yes, I can tell from the podcast itself. Yes. Hey, you have your strengths. You stay in your lanes, right? That's
Exactly.
as a
He can talk to
partnership.
contractors all day long. He is in his lane, man. I
Yes.
appreciate that. Um, so back to the debt. What was the fixed rate on this? Because I think listeners
Six
wanted
and three quarters. Yeah.
6 3/4.
And I think right now, as of this recording, I mean, community banks are around 7.5 right now. We're working with credit unions, read the fine print in credit unions, but we just got quoted 6 3/4 for a deal with credit unions. It's, 80% loan to value on this deal. I mean, loan to cost, I'm sorry. 18 months of interest only, 25-year amortization. Unfortunately, it is recourse debt. The debt is recourse. But I mean, for us, we're going to buy the deal. We're going to manage the deal ourselves. So we think that is a fair trade-off. What we'll do is we'll reposition the asset after 3 4 years when rates are favorable to us. We'll just refinance it into agency debt.
Got it. Um, I before we move on to like, how you structured the capital and the partnership on this deal, I want to pull out, you kind of just glossed over it. You said read the terms with credit union, reading the fine
Yes.
print. What do
Yes.
you mean by that?
Well, credit unions aren't banks. And that's the interesting thing. So that's what I've learned. Make sure you read the fine print as far as people who are signing on the debt itself. Are they co-signers? Really read the fine print. We've done one deal with the credit union. We love using them, but just make sure they're the right credit union for you. That's really what I like to say about credit unions because they aren't banks. And then you're gonna have to join the credit union as well. And then you may have to open up other accounts with them. So just find out what credit union fits what you're trying to accomplish because some of them may not want to lend on multifamily. We found the credit union in Tennessee that likes multifamily, so it works really well for them. They like it in their portfolio. And it's ironic because credit unions are nonprofit. They're not there to make a profit. That's why their fees are cheaper, their rates are more competitive. Whereas 3 or 4 years ago, they weren't even, I don't even think people mention them in conversation because community banks were really competitive. But now with rates being as high as they are, and with community banks, their reserves being depleted because people are just going out and finding T-bills or different alternatives for putting their reserves. Banks have to go out and lend on the open market. It's more expensive. So if they're lending at a higher rate, they're going to have to charge the consumer a higher rate as well.
So just to sound that back, the credit unions can make good partners, but they might have a higher rate. Is that what you're
No,
saying?
credit not higher rate. You just want to be able to read the fine print. You
Okay.
want to be able to make sure and understand as far as co-signers, as far as any kind of obligations you may have to them going forward in the future, anyone else on this loan, just make sure you read that fine print.
Awesome. Okay. Thank you for clarifying that for us. Now, I want to get back to how you structured the deal. You mentioned you had two other partners, and then you also have your Golden Ticket Club, which has a 5% raise to it. So how did you structure the deal amongst your two partners and then also with your Golden Ticket Club?
It's interesting because technically it is a syndication because our employees are really working with the expectation of getting a return and some of them aren't working on this property specifically. So we had to structure it as a syndication. So we created the documents, private placement memorandum, and this is a tip that I would offer anybody doing this with your employees. You have to really talk to a securities attorney and make sure on the front end if somebody's going to be passive in this deal and they're expecting a return and they're passive, you are creating a security. So make sure you get that worked on the front end. What we ended up doing with the partners, we just did basic equity. If we have to raise $1 million, let's say for this deal, I forgot how much it was. I think it was 2 million. We would say if we're 90% of it, we each bring 30% of the equity, and whatever 5% we split it up for the employees based on how much they can bring. And for anybody listening, it is a massive benefit to the employees because they're getting equity in a deal. They're getting an opportunity dollar for dollar. We don't charge fees to employees. We don't, they are in as if they were partners on this deal. So it's a massive benefit to them. But if you're trying to create an enduring organization, if you're trying to create culture within your company, what better way than to allow them to participate in these deals? And what ends up happening is your great employees will continue to stay with you. They'll be looking forward to investing in the next deal. And then you'll start hearing things from property managers like, I think we need to raise rents instead of you telling them, because now they have ownership in the deal. And they're like, wow, this is how the property works. They don't feel as bad when all of a sudden you have to actually execute in the business plan because they understand ownership right now and they're bought in on the project. So for us, it's been really massively beneficial to allow our employees, if they've been working for us more than 2 years, to participate in the deal.
So your property management is vertically integrated into the organization? Okay.
Yep.
That is a great clarifying point there.
Yes.
Um, okay. So you already mentioned that the whole time on this is 5 years. You might reposition, and continue to hold this. I wanted, just since you purchased this property back in July, I want to take a little bit of a moment here to talk about, were there any issues that came up after takeover? How has that gone?
There were a lot of issues after takeover. And it's one of those inflection points in the economy where things are starting to slow down. And there's a lot of properties out there where rents were nowhere near where they should be. And rents when we took over this property were $700. And a lot of the residents, they felt the pain. They knew we were going to take the property over and raise rents. And there was a mini revolt. A lot of them got really upset. And you have to understand that's part of the business. Now, how you handle it, I mean, we went in there and the leases are the leases. We're not, you have to honor leases. But it got to the point that it got really challenging. And when your rents are at $700, there's no way that you're able to run a property with that price point at 100,000 a unit. There's just no way. Your taxes and insurance make up the bulk of that. So I don't think residents understand that. We really pulled together as a team. And what we ended up doing was we just told people, whatever your leases are, we'll be able to extend some. But as units became vacant, those are the units that we ended up tackling and ended up turning. And as to date, I've written it down. Out of the 105 units, we've got 57 of them on what we call a RAN lease. So we've still got about 40 units to go to be able to turn because, Whitney, you don't take them over all at once. They have lease terminations. There's, if you take over in July, some people have a year-long lease. So we're working through that. But on the front end, it was challenging. It was difficult because people are used to seeing such a low price point. And I think they were a little unexpected when we took over. Day one, pools running. Day two, cutting trees. Day three, concrete going. I don't think they expected that. So I think long term, when you have that tenant reshuffling and you have new residents coming in, and we're still 20% below market of where other rents are, I think the new resident base will truly appreciate what you're doing. And some of those old residents that understand, well, if they're going to go down the street, they're going to pay market anyway. Let me stay at this property because these owners are taking over this property. It really comes down to communication and really comes down to really elevating your property management because it's difficult. The first couple of months can be difficult taking over a property like this.
Mm. Well, thank you so much for sharing for that because I think that is, especially in the value add space, that is so much emphasis is on buying right, but then you close the property and your business plan is not done. It's just not.
Yes, it's just starting. Yes, I
Just
agree.
starting.
Mm-hmm.
Well, Gino, as we wrap up the show, what did you find easy during this process of closing on this property that you thought was going to be more challenging? And what did you find that was a little bit more challenging that you thought would be easier?
I don't know if there's anything easy in life. I think the process of, closing over 2,200, transacting over 2,200 units, the fear never goes away. There's always some doubt. There's always some uncertainty, but I felt comfortable with the process. And I really felt comfortable with this asset long term. Like, once again, it just checked all of our buy right criteria. If our exit strategy is to refinance and hold this property for the long term, I can see that with this property because it's got great bones. It's got great area. We love the submarket that it's in. We love the amenities, the size. We love all of that. So that was the easy part. The challenging part was really executing the business plan and continuing to execute it while we had another heavy lift going on. And this is a cautionary tale for anybody out there that is listening and on Instagram and seeing people closing thousands of units and saying, I want to be like that person. Don't outgrow your infrastructure. Don't worry about what anyone else is doing. Mind your own business. And if you have to pass up on an opportunity because your plate's full and you can't scale, that's okay. You're in this business for the next 5, 10, 15, 20, 30 years. It's okay if you miss on an opportunity short term, because if you take that opportunity and you stumble and fail because you didn't want to miss that FOMO, that's a bigger problem than actually missing the opportunity in and of itself. It was challenging, Whitney, to get these two deals lined up, to have two different CapEx teams going, and actually be able to scale up the employee side of it, because at that time, about a year ago, it was challenging to find a lot more employees, especially on the maintenance side.
Wise words. I think someone said the best deal that you ever did is sometimes the one that you don't. I
Yes.
probably botched that. So,
No, you nailed it. I love it. I love it.
well, Gina, thank you so much for being on the show today and sharing your experience. If people want to learn more about you, how can they best reach out to you?
Just go to jakeandgino.com. If you want to listen to a podcast with my wife, me and my wife Julia do a podcast together. It's on spouse, family. I'm writing a book called Happy Family. I'm sorry, Happy Money, Happy Family, Happy Legacy. And it's something that's really important to me. So that's more on the personal development side. So if you want to check out and get more information, just go to juliaandgino.com.
Excellent. Gino, again, thank you so much for spending your time with us here today. We look forward to hearing about your future deals.
Thank you.